Hey there, I'm Somnath, and welcome to Dollar Sense, your go-to place for smart, simple money decisions. Today we're asking, should you save a large chunk like $5,000 all at once, or build wealth by saving just $200 a month? What's actually better for your future and your mindset? Let's break it down in real numbers so you can take action with clarity. In this video, we're going to compare lump sum versus monthly savings to figure out which one actually builds wealth faster. We'll also look at who should use each approach. If you just got a tax refund or work bonus, congratulations. You might be tempted to invest the whole amount and call it a day. It sounds efficient. However, research shows that people who receive a large sum of money like a bonus or inheritance are more likely to blow it on things like vacations, cars, and impulsive purchases. The behavioral bias behind this is called loss aversion. And basically it means people feel twice as much pain from a loss as they do pleasure from an equivalent gain. For example, imagine you won $10,000 in a lottery. Would you feel twice as good about that as you would bad if you lost $10,000 in the lottery? Probably not. On the other hand, imagine you had $10,000 sitting in a savings account and then it dropped to zero because of a bank run or some kind of crisis. Yeah, that would hurt. In fact, it would hurt twice as much as winning the $10,000 would feel good. And that's why people have a hard time investing large sums of money. They know they could lose some of it, and that feels terrible. Now, this behavior is fine when you don't have any financial goals. But if you want to build wealth faster, you need to develop the habit of saving and investing consistently. And that doesn't necessarily mean you have to invest a lot. For example, even investing $5 a day or $200 a month can add up to over $200,000 in 40 years if it earns an average 8% annual return. So in today's video, we're going to discuss the benefits of monthly savings over lump sum investing and who should save their money each month instead of investing large amounts. Let's get started. Starting with the first reason. Monthly savings is better than lump sum investing. If you're just getting started with investing or saving money, putting aside $200 per month is less intimidating than trying to put aside $5,000 all at once. When you save $200 a month, you're building the behavior and creating positive momentum. You're consistently building your savings without having to face the emotional stress of investing a huge chunk of your income. As your savings grow, so does your confidence. This allows you to gradually increase the amount you save over time. In contrast, if you try to jump straight into saving $5,000 all at once, you're facing a big challenge right off the bat. You might feel overwhelmed and anxious about committing such a large amount. Now, the fear of potential losses may cause you to hold back or avoid investing altogether. The key here is to start small, build a track record of consistent savings, and let your confidence grow over time. Once you've developed the habit of monthly savings, you can gradually increase the amount you save, knowing that you have a solid foundation and positive momentum to support you. Next, another great benefit of monthly savings is the power of compounding. When you make monthly contributions to your savings or investment account, like $200 a month, the power of compounding starts to work its magic almost immediately. For example, if you were to put $200 into a savings account that pays 2% interest compounded daily, you'll earn around 73 cents of interest in the first month. This may not seem like much, but it's important to note that the initial balance was only $200. As the months go by, your earnings will start to add up. After 1 year, you'll earn around $9 in interest, and after 2 years, you'll earn around $19. This demonstrates the power of compounding. Now let's compare this to a lump sum of $5,000 invested in the same savings account. With a larger balance, the initial interest earned will be higher, around $10, but the growth won't be as immediate or noticeable compared to the monthly contributions. However, there is a way to make the lump sum grow faster. If you invest it wisely, for example, if you invested in a stock market index fund that earns an average of 8% annually, your $5,000 will grow to around $5,400 in the first year. That's a nice return. But here's where monthly savings starts to catch up. If you keep contributing $200 a month to your savings account, it'll grow to around $2,625 in 1 year. So what's happening here? Even though the lump sum started out much larger, the monthly contributions are catching up quickly. The power of compounding is working its magic on the monthly contributions, making them grow exponentially over time. To make things even clearer, let's visualize the results side by side. After 1 year, the lump sum will be worth $5,400, while the monthly contributions will be worth around $2,625. But after 3 years, the gap widens significantly. The lump sum will be worth around $6,400, while the monthly contributions will be worth nearly $7,900. So what does this tell us? Well, if you're willing to take on the risk of investing in the stock market, then investing a lump sum of money all at once can potentially lead to greater wealth. However, if you prefer a more conservative approach or are uncomfortable with the ups and downs of the stock market, then keeping your money in a savings account while continuing to save and invest every month can still lead to significant wealth accumulation. But there is one more reason why monthly savings is better than lump sum investing, and that's liquidity. Let's say you decide to invest a lump sum of $10,000 in a certificate of deposit, or CD. CDs are like savings accounts where you agree to keep your money for a set period of time in exchange for a higher interest rate. But here's the catch. If you need to access your money before the CD matures, you will have to pay an early withdrawal penalty. For example, if you invest $10,000 in a 1-year CD and decide to withdraw $5,000 after 6 months, you may have to pay a penalty of several $100s. Monthly savings helps you avoid this issue by allowing you to keep some of your money readily available in a more liquid form, like a checking or savings account. This way you can always access some of your money without any penalties or hassle. Now, it's important to note that CDs can be a good option for longer-term savings goals, where you do need to access your money for an extended period of time. However, for shorter-term goals, or if you anticipate needing access to your money sooner rather than later, monthly savings can be a better choice. By consistently saving and investing each month, you're building a habit that can lead to long-term success. It's a great way to stay motivated and keep your finances on track. When it comes to who should choose lump sum investing versus monthly savings, it depends on your individual circumstances and preferences. Generally speaking, if you're new to saving and investing, starting with smaller monthly contributions can help you build the necessary confidence and consistency. For example, freelancers who receive irregular income, students who have part-time jobs, or anyone who is just getting started with investing may benefit from saving and investing smaller amounts each month. By consistently setting aside $200 or $300, you can gradually build your portfolio and gain experience in the process. On the other hand, individuals who receive tax refunds or bonuses may prefer to invest a lump sum of money. These windfalls can present an opportunity to make a significant investment in a relatively short period of time. For example, if you receive a $5,000 bonus, you could invest it in a certificate of deposit, CD, or in an index fund like VU or SPY. By choosing a CD, you can lock in a fixed interest rate for a set period of time, providing you with a steady stream of income. Alternatively, investing in an index fund allows you to participate in the growth of the broader market and potentially earn higher returns over the long term. In conclusion, both lump sum investing and monthly savings have their own advantages and disadvantages. There is no clear winner. It really depends on your individual circumstances, risk tolerance, and financial goals. What matters most is developing a consistent savings and investing habit that works for you. Whether you choose to invest a lump sum or save and invest monthly, the key is to start early, stay consistent, and stay motivated. Remember, the best investment you can make is in yourself. Keep learning, keep growing, and keep building your wealth. Thank you for watching. If you enjoyed the video, please hit the like button and share it with your friends. Subscribe to our channel for more informative videos. And as always, stay smart with your money.